Welcome to Insights for Business Owners. On this episode, we have Josh Bobrowsky, who is the CEO and founder of NextCompany. Josh, thanks for coming on the podcast.
David, thank you for having me. Always a pleasure.
Cheers. Well, fill folks in on what you're doing at NextCompany and how you got here, because you have quite an impressive background in history that I think informs why you decided to start this company.
Sure. So to start with my background really quick, I've built and sold companies for the last 20 years. I've done a bootstrap to a small exit. I've done a turnaround of a fuel additive company out of Houston, the VC firm I put some capital into, and I've raised some venture capital out of New York City as well. And then after that, I decided it was going to be time to move on to what my current venture is, which is NextCompany. The idea is really to provide the software that small businesses need to prepare for a sale, and then also to assist with growth and brokerage or preparing to get the company sold and then the transition there afterwards. My general take is that the companies that need the help the most are often the ones with the least resources and are getting the worst representation across the board. And so you might have a plumbing company that's very valuable, doing $20 million a year in top line revenue, but their books aren't really in clean order because their cousin or their neighbor or their friend happens to be their accountant. And so NextCompany comes in a way that APIs directly into the banking relationship, is able to set up a full dashboard. And then, given my experience with buying and selling companies in the past, able to take a look at how to prepare this for a sale, negotiate a sale, and then even able to look at how to transition after the sale. Things like seller's notes are super important, and the relationship tends to continue thereafter.
That's so great. And it sounds like you found kind of like this missing piece in the space, right? I mean, probably most of the people in this space are like using QuickBooks or some of the other, sort of SaaS bookkeeping products, but they're not really filling the void, it sounds like. And you found like something that really needs help.
Well, I think most accounting at a small business level is done in preparation for taxes. And I think that there's a very different conversation to be had around what type of financial analysis should be being done in order to help a company grow or in order to help a company sell. And I think that even though they sound at a top level like they're identical things, hey, I have an accountant, so they must be doing all the things, but there's often a lot of nuance that comes from not just being able to look at the numbers, but being able to look at the numbers and evaluate what does this mean for the performance of the business, or what does this mean for the future of my company? How does my cash flow relate to my monthly expenses? Where are leaks in my business? Where are opportunities? These are all things that I think more in line with like an outsourced CFO and a little bit less like a bookkeeper or accounting software, if that makes sense.
Right. That's great. So can you help people evaluate, hey, I want to bring on some more employees. What's that going to cost, but what could I potentially make from that? Like, is it, is that something NextCompany can help with?
Sure. I mean, you take a look at where your revenue per employee is. You take a look at what your attrition costs are, like when an employee turns over. You just look at roles and what an acquisition of a new employee would look like. What type of people you're looking to bring on that are going to fit with the culture of your company, and what that's going to look like as it grows and how things are going to change. A 5-person company is different than a 20-person company.
Right.
Sometimes it's time to bring on somebody. I tend to err on the side of spending a little bit more per employee than your average person. I think that you just end up getting a better ROI. And if you're overpaying somebody a little bit, the cost to your company is pretty negligible, but it's very meaningful to the individual. And so you have better retention. I think people underestimate the cost of attrition over time.
Yeah, no, and it's funny. It's sometimes I use the podcast as sort of asking for a friend, but sort of lightly asking for myself. I think that's great advice. I think that really is great advice, and I think my own company too. This kind of tool is amazing because as a small business owner, you're just using your gut on a lot of this. And you have numbers, like you said. QuickBooks can spit out a profit and loss and give you your balance sheet and actually I get a cash flow statement, but I don't totally understand it. But this takes it to the next level, and you can help
Well,
people
you,
make
you
those.
just actually hit on the exact thing that is the issue. I get a
Right,
cash flow statement. I don't totally understand it. And
right.
so that's not a coincidence. It's not that you're doing something wrong. There's an intentional basis of many accountants, which is to obfuscate what is going on.
Wow.
This isn't just accounting. This is high
Yeah,
finance. I've done work with large hedge funds and different
yeah.
organizations. And so there's an intentional coding of language that
Mm,
is designed to make it hard to understand.
right.
And so if you and I sat down together, David, and said, instead of having you say, I don't understand my cash flow, we sat down together and let's look at where every dollar is going. Let's
Yeah,
take out fancy terms. Let's forget
right,
amortization schedules. Let's not talk about GAAP accounting, but let's actually look at what matters for your business and say,
right.
okay, cool. You're doing about $600,000 a year in profit right now. Let's look at how
Yeah,
we get you to 1.2 million. Let's look
yeah.
at kind of what that looks like in that transition. What does your life as an owner look like? What
Mm,
shifts need to be made? What hires need to come on board? And so that's a great example of what I think you should be looking at. You being a general person, but
right.
you actually hit the nail right on the head. Of
Yeah,
I don't understand a piece of my business, and it's not
right.
a minor piece. Outside of the operations of your business,
Right,
whatever you
right.
do, there's two things that are most important in my opinion. After
Yeah,
your operations, there's your finances and there's your marketing or distribution. And if you
yeah.
can nail all three of those, you can be a massive company, you can be a profitable company. But if you're only hitting one or two or out of the three, you're always going to be like missing a little component to it.
Yeah. No, I think the conversation's going in different directions here, but I think that's good. You hit a great piece, which is, and I think you're doing this, you are democratizing finance. And I think what is intimidating, especially for small business owners, is all the jargon. It's a foreign language. And if you aren't steeped in it, you don't feel comfortable. You literally do not know what people are saying. And it sounds like you're bringing that to the masses of the small business owner, which is great. Like it's so needed. Um,
And this stuff isn't that complicated.
right,
If we were looking at, most small business, you're almost looking at addition, subtraction. I mean,
right, right, right,
there's a little bit of maybe like multiplication and division, but it's not like we're looking at creating an automatic market maker that's going to have some really advanced math that coincides with this. This
right.
is more about just understanding what the numbers are saying and why and what's going
Mm,
on. And like once you can understand that as a business owner, I think that the way you think about your business begins to change because,
mm,
one of the things you'll kind of learn is that some of what you thought was true may not be true into the
right.
future. And if
Mm,
that's the case, you can figure out, oh, wow, this thing I thought was true is false. Once I get
mm,
past that, I can go from making $5 million a year to 15 million. And at
right.
15 million, there's another thing I think is false. And how do I remove
Mm.
that barrier? That's kind of the stuff I look at.
Yeah. Can we talk about it? I'm just throwing the interesting things out here that I've wondered about. I think it's called the J curve. Is that right? It's like where sometimes you have to spend more money and you're become less profitable for a while, but then like bringing on more people or bringing on more equipment. But then as you get through that, you become more profitable.
Sure.
Am I misstating that definition? Is it the J curve? I can't remember.
Um,
Um,
I don't know if it's referred to as the J curve, but there's obviously going to be a transition of, let's say you're one person, and every
yeah, yeah,
dollar of revenue you bring in is basically going into your pocket. The
yeah, yeah,
first
yeah,
time you hire let's just say you're making $400,000 a year in
yeah.
revenue, and like
Right.
350 of that goes directly into your pocket,
Go see. Right,
and then
right,
you need to hire somebody for $200,000 a year to help you grow.
right.
uh,
Yeah.
you're going to lose a little bit of profitability. This is often why companies raise venture capital, because a company, in order to grow, you're going to pull back on cash flow at
Right.
all times, right? So,
Yeah,
like,
yeah,
it took Amazon years to become profitable. Uber's a massive company.
yeah.
These companies could have never grown to scale
No.
without venture. And so when you're bootstrapping or building it without
Yeah.
outside capital,
Right.
it's always going to be this balance of you're going to have to take like one step back to make two steps forward.
Right. That's what I'm talking about. Yeah, yeah. And that is interesting because you do come from the venture capital world, this high finance world, but down in SMB, like you're funding with cash flow and loans, pretty much to grow. I mean, sometimes they're investors, but a lot of small business owners don't want that. They don't want to dilute, any dilution. And so talk about that, like from the SMB perspective, because it sounds like your NextCompany's tools also really geared towards those probably folks in businesses that couldn't attract venture capital anyway, but they also probably don't want to.
Well, I think that you should be in any business understanding what the goals of people on the finance side are, right? So if you're looking at somebody who's doing venture funding, most venture capital firms want to return their entire fund with a few really good investments, meaning 6 out of 10, 7 out of 10 of their investments go to zero, but they hope 1 or 2 or 3 do 1,000x or 100x, and that returns the entire fund. And so they're looking for these like hyper growth companies that are going to go from $0 in revenue to $1 billion in revenue. And that's like a venture capital play. When you get into private equity, which is actually probably more, and to be fair, like to use appropriate terms, like there's public equity, which is publicly traded companies, and there's private equity. And venture capital actually falls under private equity. But most people, when they say private equity, mean like small business private equity. So just for clarification of proper terms. Then you have private equity, which might be in the small business space looking to do a roll-up of roofing companies or garage door repair companies or wellness centers or something like that. And you're going to look at what do those players want to have when it comes to the businesses they're acquiring. And then on a different side of things, you're going to look at like, what does a search fund look for? And you've got somebody that's fresh out of Harvard or Wharton, and they're doing like a search with a little bit of outside capital with some commitments, or they're and then you're going to look at another universe of people, which is the people that are doing like an SBA 7 loan, right? And so
search. You
got these self-funded searchers. Now, the self-funded searcher, a lot of what they're going to be limited by is what the bank will approve. So at every stage of the business, like if I'm talking to a business and you have a business and you're looking to sell, we won't look at who your potential buyers are, what their motivations, what their limitations are. So like, if we're looking at self-funded searchers, it's going to be pretty tough to get over $5 million loan. I mean, maybe you can get pari passu for like an extra million or two. But like if you have a $12 million company, you can say, okay, like I'm kind of out of that. I'm at the lower end of private equity, and let's start to talk to some private equity shops. But before we go into those different things, you always want to structure your business in a way that makes sense for the counterparty so that you can have a really easy conversation. So whether 100%. That's me, whether that's the software, whether that's an amalgamation of the two, you want to be able to sit down and meet people where they are. You don't want to come in and say, we've got $5 million in profit, and a private equity shop goes through your books and like, what are you talking about? You have $2 million. Because all of a sudden, they're going to look at you and say you're either incompetent or a liar. Which one is it? Because
exactly. It's only 2 options. Right.
And so that's a really poor way to start a negotiation. And then this is going, if you're giving any time, if you're doing an all cash deal, maybe a little different, but most of these sellers are giving, credit or a loan on their behalf. They're having an earn-out. They're having a consulting agreement. And so you're going to have a relationship with these people. And so you kind of want to think of this relationship starting the first day you talk to them and ending the last day you talk to them. The relationship doesn't start once you close the deal. So I try to think about all these things beforehand. And if you think about all these things before the relationship starts, you're going to be able to sit down with more serious players. You're going to be able to sit in rooms with better people. You're just going to end up with a better outcome at the end of the day. And so that's kind of where my head is at with different things.
I love it. Can you, speak to and are you able to help the sellers evaluate an equity role? Because I think like, especially as you get down into that lower private equity type, market, some sort of role is generally included, like 10, 20%. But I feel like, the sellers are so unsophisticated on whether that's a good deal, like whether it makes sense, what is it actually worth, Do you get into that as something, that you can help people with?
Yeah, I mean, I think you should have a conversation about every piece of your deal, right?
Yeah.
Just like we said earlier, like I don't understand this portion of
Yeah.
my cash flow. I
Yeah.
think just like you should understand in an optimal world, right? If you
Right.
like, let's just say you're making $1 million a year right now, to understand a few of these like things that are black boxes, that might
Yeah.
be the unlock that takes you to $2 million a year.
Right.
For a seller, you don't want to have a part of your agreement that you don't understand
Right.
because you don't know what the outcome is. So, like, you should understand what the tax implications are of an asset
Yeah.
sale versus a stock sale.
100%.
You
Yeah.
should understand what it looks like if you're going to extend a line of credit to the sellers. What percentage of people are actually getting paid back on those deals?
Right.
What where you stand in the debt stack, right? So you're
Yeah.
probably going to be junior to the SBA loan. What
Very
happens if
junior.
they default? Where
Right.
I just think if you know, the more you understand, the
Yeah.
more you and the other party can reach an agreement where both sides are happy. And the less you understand, the more likely you're going to have like a huge problem.
Yeah, no, it's a great point. And it's funny because one of the things that I find people are so unsophisticated on is secured lending. And like you said, where you fall in the debt stack. And, I try, people just, they love the seller note and think it's great. And I'm like, hey, you have a UCC lien behind the SBA. And you've signed a subordination agreement. So you
Yep.
basically can't do anything with the collateral without the SBA's approval. It's not great security, right? Like it's just and the basics of this, people just have no idea. People don't even know what a UCC lien is. And that's kind of
Yeah.
amazing. A lot of them have MBAs. I'm like, is this not brought up at all in business school? I'm like, I'm shocked by it actually.
What I think is a little bit more curious to me is
Mm,
that people lack just the curiosity to
right.
learn what it might be. And so, like, your senior debt gets the best thing, your junior
Yep.
debt after that, your equity
Yep.
stack after that.
Yeah.
And so, to understand the nuances of that, to understand counterparty risk, this is
Yeah.
something I talk about all the time. Like, sometimes people get really into insurance policies, right? Like, there's
Right.
tax
Right. Right.
savings, and I always say, like, what are your thoughts on counterparty risk? I'm like, what do you
Yeah.
mean? And
Yeah.
what happens if the insurance company doesn't exist in 15 years?
Right.
Where do
Right.
you
Right.
stand? Well, I don't know that.
Yeah.
I don't know. I mean, I just try to think through different things that could happen. Hopefully they don't. And
Yeah.
then once you know those things, I just think you're in a better spot. So I'm always erring on the side of helping people understand more moving parts in their deal and not getting bogged down in the minutia, right? Like you don't necessarily need to be spending hours or days on understanding every pref in the debt stack,
Sure.
but you might, right? Like you
Yeah.
might want to understand that. That's probably not a bad idea.
Right.
So that's kind of my take on things.
No, I agree. I mean, I find clients want to get so deep into every rep and warranty, but then really don't think through, like you said, the counterparty risk and what happens, if the deal goes south and where are they in the debt stack and sort of what does it realistically mean? What is it like to try to collect money, on a service business when all you've got is a UCC lien on like AR, basically, um, and it's, I tried to explain to them, I'm like, really, like, if you're selling a good business, your guarantee of getting paid is that it's a good business and it's going to continue. If things really go south, your seller note is, it's not great. I mean, it's okay, but a lot of other people are coming after this person. And I think that kind of financial literacy is just really helpful. And it sounds like what you're doing with NextCompany really helps break these myths, which is awesome. How far in advance should a seller come? Far advance of sale should a seller come and meet with you and kind of get going?
I mean, optimally, like 2 years, right?
Yeah.
That's probably like absolutely optimal is
Yeah.
start to structure the deal in a way that it's really tight. So whether you're going to be doing an SBA loan and the bank can see 2+ years of financials that are really tight, and it's typically not that hard to clean up a year back in financials.
Mm,
I think
yeah.
things get really sticky when you start trying to clean up like 3 years, 4 years back, or at least reconcile where things stand.
Right.
I think that, yeah, 2 years is probably optimal. Just because, that being said, if someone wants to sell their business in a month, like, I'm happy to work with them on that. And that's
Yeah.
a totally fine thing. But in a perfect world, you're preparing years out for this. What what I think sellers should understand is everything is kind of a numbers game, in the
Hmm.
sense of, like, if you have to sell your business in 3 months because you and your co-founder are having like a issue that you can't resolve, that
Yeah.
can be done, but you're going to sell it for a lower price than if you two can work
Yeah.
together for a year and get the thing prepped. There's just a lot of ways to do this, and depending on how you structure things, your business looks like a growth asset versus a stressed asset.
Hmm.
I think that's really important. I think you want to be, the last thing a buyer wants to see is you're like down year over year. So really,
Right.
a lot of times I think a seller's trying to take their foot off the gas, and then they take their foot off the gas a little bit, and they earned a little bit, they earned this much last year and this much this year, and next year is looking like that. Like, oh, it's
Right.
time to sell. And the
Yeah.
reality is you kind of want to do the opposite of that,
Right.
because part of the multiple that you're going to get is based on growth or lack thereof. So
Right.
that's why I think 2 years out is a really good sweet spot, but you can work with
Yeah.
people at any time.
No, it's a great point, and I think yeah, you like that. Which direction does it look like the business is going? Like that makes a big difference. Down in our smaller world of SMB, sometimes we're dealing with the difference between SDE and EBITDA. And are you able to help folks? I mean, kind of the smaller businesses are more sort of like in that SDE, and are you able to help with that and that definition, like, and how to build that? Versus maybe then, hey guys, how do we move this more towards like EBITDA type business?
Well, I think it's the same thing, really. I mean, at the end of the day, you're just trying to show the buyer how much money they're going to end up making. Whether you
Yeah.
call it EBITDA or SDE or whatever you want, all you're trying to do is present, this business makes $1 million profit per year, and we
Yeah.
can define profit in different ways.
Right.
I'm also really big on, I think you should be very consistent. I think you should be very high integrity, right? Like,
Hmm.
you talking from a buyer standpoint, like, I'm always really cautious for a buyer. If a seller's like, here's a ton of money, I told the IRS was
Right.
tax deductions, but it's not true.
Right. 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 Right.
That's a red flag to me, because now you have
Yeah.
somebody who, kind of wants to skirt the rules. And so I think
Right.
I, I think you could define profit in a million different ways. You can look at
Yep.
it, and something like EBITDA, I think, doesn't make a lot of sense if you have a business where you're going to hold a ton of interest into perpetuity. Right?
Yep.
It doesn't make a ton of sense if you have a business that holds assets that depreciate a lot. Right? So
Hmm.
hypothetically, like, let's say that we have a tree service company that
Yeah. Yeah.
has 100 trucks.
Yeah.
And there's going to be this incredible amount of depreciation every year on these
Right.
trucks. They're going to have a 10-year timeline.
Yep.
100 trucks might be $10 million or more in inventory, and your depreciation is
Yeah.
going to be like $1 million a year. But
Right.
if you take that off of EBITDA, the depreciation factor,
Yeah.
that's a very material portion of the business that you're
Huge.
not looking
Yeah.
at. So I think getting away from SDE and getting away from EBITDA and just really kind of looking at what's the business going to make.
No, that's a great point. It's really business specific.
Yeah, very much
Yeah.
so.
Yeah.
Right?
And then in terms of like, I know this because sellers, right? A lot of, and we deal with this all the time. It's like, oh, can't believe like running $800,000 in perfect, personal expenses through the business, and I'm like, oh my goodness. Um, Going to that tax return probably is key, right? Like, what are they declaring is true, like profit, right? Is that kind of a good
Yeah, I
place to
think
start?
I think anytime numbers don't line up, you go back to that statement that I said earlier: of, are you being dishonest,
Right.
or are you too much of a fool to understand what's really happening?
Yeah.
Right? And when you have these like really big discretionary numbers, like it, it, you know, it, then you kind of get into this gray zone of, because I put myself in the buyer's shoes because I bought companies before.
100%.
It,
Yeah. 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 Yeah.
I put myself in the buyer's shoes and I say, like, well, if someone's really far off, um, but I got to ask why.
Yeah.
And it feels to me like the most logical things, or they're dishonest, or they're not understanding how the numbers work.
Yep.
And maybe there's somewhere in the middle where
Hmm.
a little bit is fuzzy, and then their accountant is kind of pushing. But I think those things tend to be red flags. I mean,
Yeah.
I'd
Yeah.
rather I'd rather look to buy a business that does $2 million in profit and says it does 2 million
Yeah.
than deal with a business that, and as a broker or whatever,
Yeah.
I don't really want to work with a seller who wants to grossly misrepresent what the value of their business is. Like I want to show
Right.
up with a very defensible profitability where someone
Yeah.
who is very nuanced can look through it and evaluate. We can debate issues on it, but that's how I
Yep.
want to look at it.
No, I think that's a great point, and I think one other area which we do see a lot, and I've been guilty of myself, is if you have several businesses, um, you know, it can be easy to mix, and there's certain, especially in like small business space, and it takes a certain discipline to keep it all very separate. um and I imagine you do see that sometimes, and that
Sure.
it's not so much dishonesty, or it's probably like lack of laziness, I guess. Really, it's sort of lack of organization, and maybe that's another red flag. I guess it is.
Sure.
um but that does happen, especially if you start little ventures on the side and things. Yeah.
Yeah, I mean, as things get bigger, they should get better, right? Like,
Yeah.
cool. You have a
Yeah.
side business, and it's a consulting outside of your law firm, and you're
Right.
doing 30 grand a year with
Right.
it. Yeah, maybe that's a little bit here and there. By the
Right.
time it starts to get to doing $1 million a year, you should
Oh,
probably
sure.
have that
Yeah.
kind of
Yeah.
buttoned up, right?
Yeah.
So, like,
Good point.
it,
Good point. Yep.
yeah, I mean,
No.
another challenge is cash businesses are hard, right? Like, if you have a pizza shop, that's probably
Yeah.
a tough business to work with because
It is.
it's just
It
tough
is.
to really know what they really do. I mean, you
It
could
really
say
is.
any
Yeah.
number.
Yeah. It's interesting. Like I'm just nodding at all these statements because it's just we've seen it over these kind of problems over and over again. You get these cash businesses, and you're like, man, how do you know like what's really true?
Right.
It's really, really hard, and it's
And,
it's funny because those are just not that saleable for that reason. Like they're a great job replacement type business, but how do you sell it? How does someone value it? And maybe that comes down to like the key point of what you're doing is you cut through the noise and get people the true picture for exit or for acquisition or for growth and improvement. Um, and that is so crucial.
thank you. No, I think that's kind of the game plan. I mean, I think just being able to clearly communicate what's occurring, I think is very valuable. And then, putting yourself in the counterparty's shoes, I think is valuable. I think
Yeah.
it just being high integrity, like start to finish, makes life very easy.
I like it. No, and it's not a word we're hearing much these days, but I totally agree. It's so important. Josh, what is the best way for people to find you and Next Company?
NextCompany.ai is the business website. To find
Nice.
me, I'm on LinkedIn under my name. I'm on Twitter under my name.
Sweet.
Those are probably the two easiest ways to get in touch or meet with me, but pretty easy to find me.
Great. Thank you so much for joining us. Really appreciate it. I've learned so much. Of course, I had to ask some of my own personal questions of interest because when I get a smart person in front of me, I gotta find out for myself. But I think it's also useful for our listeners. So really appreciate you. Thanks for coming on.
Thanks, David. Appreciate you having me.